This is FRM Part 1, Book 1, Foundations of Risk Management. This is Chapter 7 called Deciphering the Liquidity and Credit Crunch of 2007-2008. It could be called What Not to Do that will lead directly into some type of a crisis. I remember in this past chapters I've emphasized the identifying of risk, the quantifying of risk, and the management of risk. Let's go ahead and see if any of those tasks were used in the period prior to 2007. Let's look at the learning objectives for this chapter. Describe factors that contributed to the lending boom. Explain banking industry trends. How about securitization and structured products, how they were used by investor groups and maybe used poorly, and how they contributed to the financial crisis. Certain economic mechanisms that amplified the mortgage crisis, distinguish between different kinds of liquidity. And there's the important part of that learning objective: how, if there is a decrease in liquidity, this learning objective uses the word evaporation. How about that? How that can lead to a financial crisis. And then understand counterparty risk and how that leads to, kind of overall economic risk. Let's start with a definition of a credit boom. A lending spree, rapid expansion of lending by financial institutions. And this goes on for such a long time that it's probably not sustainable. Let's go back to our corporate finance days. When corporations borrow, what do? They borrow to fund positive net present value projects. And so what does that mean? That they rank them. Of course, they can rank them according to NPV or their internal rates of return. They're always going to invest in those projects that have the highest internal rate of return, and then next, and then next. And so each subsequent project has a lower internal rate of return and therefore lower net present value. And so when a firm continues to borrow, it's investing in projects that are approaching its weighted average borrowing cost. And this is okay as long as the economy is expanding, as long as that particular firm is increasing its operating cash flows so that it can meet all of its debt service payments. But as soon as there's some kind of financial distress and those operating cash flows fall below the debt service or near the debt service levels, well, then all sorts of things start to break down. The important thing here is to remember this word that I've used called contagion. That's an academic term used back in the 1980s on studies for currency crises. But here, the idea is that financial distress between and among banks, that can affect every sector in the economy. So what goes on inside the financial services industry is critical to the success of the overall economy. What happens then is if there is excess credit growth, and that's going to lead to an increase in financial vulnerability. All right, what happened in the lead up to the 2007-2008 financial crisis? Lots of arguments. Regular readers of the Wall Street Journal will have a pretty reasonable take on what led up to this financial crisis. But essentially what happened is that starting in sometime in the 1990s, there was economic expansion during the Bill Clinton presidency years in the United States, and that led directly into increases in housing prices. And this continued through the George Bush years. But somewhere in there, started maybe with Bill Clinton, continued maybe with George Bush, that financial institutions relaxed their lending standards, either through some kind of an internal mechanism or maybe some kind of external encouragement so that more individuals could own homes. And so this led directly to rising housing prices. increased demand for prices, so therefore, increased demand for houses, and therefore prices rose. And so, there was some people from the Fed and others who used this term irrational exuberance, which was kind of a phrase to describe nobody's really, what was that? Identify risk, quantify risk, and manage the risk. So this encouraged speculation. And, the fascinating thing is that historically, individuals and families would buy homes just to live in them. And then if they had to move, they hoped to sell it at a higher price. But sometime during this period, there were lots of people who looked at their home as an investment. They looked at their home as part of their equity portfolios. And that encouraged, that was a part of speculation. And so, of course, this works. This works as long as the economy is expanding and home prices are rising. But as soon as they fall, even just a little bit, there's going to be a rapid rise in mortgage defaults. So this was the bursting of the housing bubble. So who sustained losses? Mortgage lenders, of course. Mortgage lenders who are doing the original mortgage lending and application process and all that stuff. Lots of them filed for bankruptcy, and others were acquired by other financial institutions. An interesting personal note is that in our current house, where my wife and family live, we had a countrywide financial mortgage. And interestingly enough, I refinanced that mortgage a year or so before the crisis. All right, so mortgage lenders, of course, investment banks who were responsible for all of this securitization, and we'll talk about that in just a few slides. Foreign investors, and then insurers. Oh my gosh, we've read about AIG and others who lost tremendous amounts of money in the credit default swap market. All right, what about trends in the banking industry? So let's think about this. What do banks do? Go all the way back to the beginning of time, and maybe not the beginning of time, but let's go back at least to the 1920s or 30s or 40s. What did commercial banks do? They accepted deposits and they made loans. So think about the life of a commercial banker. You have a customer comes in and says, I want to borrow $50 or $100 or $500,000 for a house. I'll pay it back over 30 years. And so think about what that means, that the banker was going to do all the credit because they were exposed to do all the credit analysis because they were exposed to all the credit risk, because it was their job to collect the principal and interest payments for 30 years. Oh my gosh, that's a long time to generate some kind of an internal rate of return or maybe even a yield to maturity. So what happened was that banks realized that they could package those loans together and sell them and generate higher profits. All right, so this was a trend of originating the loans and then distributing the loans rather than holding them on their balance sheets. All right, so then we've got this huge secondary market in the form of securitized assets, like asset-backed securities, like collateralized debt obligations, and of course, mortgage-backed securities. But at the same time, let's think about this. So the banks were selling their long-term loans. Now remember, they're on the left-hand side of the balance sheet for banks, so they're the assets. So they were selling their long-term loans, but then they were financing those on the other side of the balance sheet with shorter maturity instruments. And so, of course, this combination there works well. Of course, it works well if everybody can repay the loans. But then it doesn't work so well if there is some kind of financial stress. Collateralized debt obligations, these are really cool instruments. These are structured products sold by banks in which they put particular kinds of loans into a special purpose vehicle, which is an off-balance sheet financing. And so what that does is it makes the bank look less risky than what it actually is. It's formed as a subsidiary company, and it securitizes those assets. It could be any asset. It could be any kind of a loan. It could be any kind of a financial security that has some kind of a payment stream. Whether the payment stream, a lot of times it's fixed, but sometimes it's not. Like credit cards, who knows how much individual credit card holders are going to pay on their monthly balance. I mean, financial institutions, they have a good model to try to predict this, and they're pretty good on average, but to identify each individual, there's no way you can determine that. So what happens here? These different kinds of loans, like a mortgage or some kind of a credit card receivable or an automobile loan receivable, these are pooled and molded into diversified portfolios. And then they are sliced into different tranches. That's the French word for slice. And so that each slice can be sold separately. Let's think about this. Each slice is sold separately, and the only people who are going to be interested in that particular slice are those people who are interested in that particular and specific risk. So each tranche has its own risk, like a prepayment risk. We call that contraction risk. Some people want contraction, some people don't want contraction. So here's the cool thing about it. They're going to pay to get what they want. So these portfolios, as they're sold individually, are worth more than the entire bag is just on the balance sheet of financial institutions. So look at that last bullet point. Tranches are sold to investors with different appetites for risk. Let's talk about this waterfall structure. I mean, this is pretty self-explanatory. I mean, what happens here? You have a senior tranche, and then you have all of the subordinated tranches. And you could have, I guess you could have hundreds or thousands of these, but it doesn't make any sense to do that. And so there are at least a couple of these subordinated or junior tranches. So the senior tranche probably offers the lowest interest rate, but it's the first to receive the cash flows from the underlying portfolio. And then the middle tranche then has probably a slightly higher interest rate and will be paid after the first tranche gets paid, and then all of the other junior tranches. A lot of times this last one's called the equity tranche because not only does it have the highest interest rate, but it kind of acts like the equity on a publicly held corporation where they're the last to get paid. Remember, all the bondholders get paid, and then maybe the preferred shareholders get paid, and then the common shareholders are last. Now, how did this securitization play a role in the financial crisis? So I've said this before. Banks found this process more lucrative. Now, what that means then is that instead of spending all of their time and effort trying to go through the credit process and say, you qualify for the loan, but I'm sorry, you don't. Because the bank was not going to hold this for 30 years. All they were going to do is package it and sell it off, let somebody else worry about the credit risk. So they lowered their lending standards so to have a larger pool of securitized assets. And I'm a great example of this. When I refinanced my mortgage, I told you this story. You can imagine that I called thousands of mortgage bankers and mortgage brokers, maybe not that many, but of course I called a handful, and I finally got this one firm, and I was asked the following questions. This agent said to me, what do you do for a living? I told him. How much money do you make? I told him. What's your current mortgage balance? I told him, and they said, you're accepted. Welcome to our world. This was a classic no document loan. I could have been lying. Of course I wasn't, but I could have been. So lowering those lending standards then is going to increase risk. So these were called the subprime mortgages, and they were offered to individuals with below average credit score. I don't even know if that agent ever checked my credit score during that phone call. Probably he did. So these collateralized debt obligations, even though they were made with high risky mortgages, their demand was high because the ratings agencies were giving them high grades, AAA rated, AA rated, whatever it was. Oh boy, look at that last sentence there. In the process of losing their independence and objectivity. Boy, this is so critical. when investors rely on professionals to be independent and objective. And if they're not, that can lead to lots and lots of problems. Now, of course, institutional investors played a big role in this because they have huge piles of capital, so they can invest in these much more readily and much more quickly than other kinds of investors. So what they did was they got around some of those regulatory requirements, because some institutions have a policy statement that says something like, you're not allowed to lend money to a homeowner. Well, if it buys a mortgage-backed security, it's not directly lending money to a homeowner. And this is true with other kinds of financial securities as well. Now, there was this great popularity of this structured investment vehicle, and regulatory arbitrage and ratings arbitrage was clearly a distorting force. Think about what that means. A better rating was assigned to the assets issued by these vehicles as compared to the individual securities in the pool. It's like, my wife never likes my analogies. It's like putting a bunch of bad apples into a basket. You wouldn't buy one of those bad apples, but if you look at the basket and you say, oh, I'll pay $10 for that basket. Clearly there's something value to those apples, because you can slice off maybe the worms or the bad parts, and you can make apple pie. Or I'm not a cook, so I don't really know what I'm talking about. Now think about what was going on here. We had really great economic expansion during the Bill Clinton years, and then outside of, let's face it here, outside of September 11th and a couple of other bumps, there was fairly good economic growth during the George Bush years. So these overly optimistic forecasts for the economy, and especially for these financial products, were provided by the statistical models that were used, and the professionals out there were adhering to these statistical models. Another problem was that the ratings agencies were generating higher fees for evaluating the structure products than based on just a regular old corporate bond. How about some liquidity issues? Funding liquidity risk refers to the possibility that a bank could find itself unable to settle obligations right away. So that means that it's not able to pay its debts when they are coming due. So think about that. What are the bank's debts? Of course, the bank has, accounts payable just like any other business, but it also has deposits over there. And so the customers, if you have a deposit in a financial institution for $1,000, you can go get your $1,000 whenever you want, right? And so there's the big risk that if it's struggling to meet its accounts payables, then it's not going to be able to meet any demand for the withdrawal of deposits. And of course, if that happens, then especially in today's information age, it's not going to take more than, let's say, 1 second for every bank depositor to become aware that their particular bank is struggling. And then, of course, what banks like to do is, when to meet their working capital needs, they like to issue commercial paper. And remember, if they issue commercial paper less than 270 days, they don't have to go through, too much rules and regulations, so they can do this relatively quickly. But of course, the commercial paper market is smart, and the commercial paper market is not going to provide that liquidity. Now, market liquidity risk refers to the risk that an individual cannot quickly purchase or sell an asset without having some impact on the price, or willing to take a much lower price. Think about this. In an illiquid market, selling quickly will require cutting the price by some amount. And so these two risks, the funding liquidity risk and the market liquidity risk, were clearly way higher in 2007 than they had been, maybe even during my lifetime. I'm 57. Is that true? I don't know. You go back to the 1987 stock market crash. There was not too many problems in the banking industry. So, I don't want to go back to the 70s and 60s, do I? All right. What about maturity mismatch? Of course, if you look at the traditional banking model, what does it do? It's trying to match its liabilities with its assets, and it's not as much maturity matching, but duration of those two financial securities matching. And so in the traditional banking model, most of those financial institutions had assets that were tied up in long-term assets. But now those deposits are going to be withdrawn on a short notice, and the bank may or may not be in the better position to meet those needs. And of course, if they're taking some of those assets and putting them in off-balance sheet models like a special purpose vehicle, well, that's shrinking the publicly available balance sheet. Now, to meet this extra demand, they relied on overnight borrowing. And, there's in the United States, we have this federal funds rate. And this is bank-to-bank loans. So if a bank needs capital overnight, it can just go across the street to its neighbor bank and say, I need $10 million because I'm going to have a lot of depositors showing up tomorrow, or I need to meet my reserve requirements. But they also use the repurchase market to try to better match. But here's the consequence. Of course, this works as long as interest rates are relatively stable. The repo market does pretty well for both sides. But if there's volatility in interest rates and a spike in interest rates, then this is going to be a problem. All right, how about some consequences? All right, so the ultimate reason behind the rapid growth of cheap credit means that interest rates had been falling. Remember, interest rates, boy, let's have a little bit of a history lesson. When Ronald Reagan took over, mortgage rates were 16 or 17%. And then through the Reagan years and then the first George Bush years, and clearly during the economic expansion of the Bill Clinton years, interest rates fell dramatically. And then during the George Bush years, after September 11th, and then we had a little bit of a recession, the Fed kept interest rates really, really low. So what this did is it increased the popularity of securitized products because interest rates were so low. I mean, everybody knows that if you went down to the bank and made a deposit, you would get essentially a 0% interest rate. So you could buy these securitized products and get a higher interest rate. And then, of course, it had to do with the drop in lending standards. What happened was that banks would transfer a large portion of their risk to other financial institutions. And this is okay as long as each bank is aware of the risk level that it's selling and the risk level that it is buying. I'm not quite sure that was the case, though. Now, I love whenever I can quote empirical evidence. So what this means is there are lots of professionals and lots of academics out there who've done tons of research on this. They provide evidence that a decline in credit quality occurred due to the increased securitization. All right, so think about what that means is that securitization directly led to more leverage and more risk. Now, I've said this before, this is okay as long as house prices continue to rise. But of course, that's never going to happen. There's no market in the history of the world in which prices have risen all the time. Now, look at that last bullet point. Clearly, those of you who read the financial press would know that even in early 2007, and surely by late spring of 2007, there were big concerns about liquidity issues and maybe a credit bubble. Politicians came out and said, don't worry about it. Financial institutions came out and said, it's not that big of a deal. And so majority were still hesitant to bet on this bubble. All right, so what's going on here from a chronological standpoint? So subprime mortgage defaults increased sharply in February of 2007. So this triggered a liquidity crisis. There was one big bank, UBS, who had lots and lots of subprime related losses. So much so that it had to shut down one of its hedge funds. Now, the ratings agencies, they were, of course, alerted to this, that maybe they need to go back and reevaluate their ratings. And so there were downgrades, multiple downgrades in the summer of 2007. And by June of 2007, there were hedge funds that were having a difficult time meeting their margin calls. Couple that with, you ready for this, about a 6.5% decline in the sales of new homes. All right, so what do you have? You have these people in homes who are beginning to default. Of course they were going to default because they got into homes that were just too big for them, for their asset base, or for their income level. So of course there had to be defaults sooner or later. And what did that mean? Then couple that with a decline in new sales. So you have the, let's call it the old demand. So the old, I'm not talking about age of the homeowners, but the people who bought homes in 2004 and 2006, they were beginning to default. And then the new people, they were coming in and looking at this environment and saying, you know what, this is not for me. So you couple these two events, this is going to result in a continuous decline in house prices, continuous decline. All right, let's switch over to asset-backed commercial paper. Remember, I said this earlier, but the commercial paper market is really, it's just a huge market that allows large institutions, of course, mainly financial institutions, to access short-term funds. But this started to dry up in the summer of 2007 because of the stuff that we've talked about in the last couple of slides. Now, this, of course, was not limited to the United States. We had some victims over in Europe. We had the American Home Mortgage Investment Corp that it had failed to secure funding. This was a big deal. What this meant is that participants in the money market, things like commercial paper and bankers' acceptances, they had a reluctance to lend to each other. Now, banks use the repurchase market all the time. Of course, they use Fed funds. They use commercial paper. In the repo market, what happens is that you have a security today, like a treasury bill, and you agree to sell it to somebody else. So you sell it and you raise capital. Let's suppose you raise 98 out of $100 in par value. So you have the 98 today. So you can do something with that 98, and then you can repurchase. You can agree to repurchase that security. Now remember, it's a treasury bill, so it's a discount security. So you're not worried about any coupon payments there. And you agree to repurchase it. It could be the next day. A lot of these repos are, a week or two. So you could agree to repurchase it for, let's just say 99 in 10 business days time. And so what happens during that 10 business days time, you have that $98 to do stuff with. And if you can turn that 98 into 100 or that 98 into 110, oh my gosh, then you're ahead of the game. And so let's suppose that 2 weeks go by and you pay 98, but interest rates have gone up and the thing is only worth 95. You agreed to pay 99 for something that's only worth 95. Well, clearly there's going to be some kind of a default in there. And so this repo market, the repo rates, of course, they had to go up. Let's talk about spreads. The difference in the interest rate between two bonds is called an interest rate spread. So the TED spread is the spread between the 3-month U.S. Treasury bill yield and the 3-month Libor rate. Now remember, Libor is a surveyed rate in which, it's the London Interbank Offered Rate. And so in London, these bankers get together at the end of the day and they say, hey, if you had to borrow from each other, how much would you charge or how much would you pay? And so it's a surveyed rate. It's an average of all those rates. And so just think about what this is: 3-month Libor versus 3-month U.S. government lending. And so this is called the TED spread. And so what happened was that these banks are struggling with liquidity issues, and so Libor is going up, and that makes the spread widen. And so whenever spreads widen, that's a reflection of an increase in some kind of risk inside of those markets, or maybe outside reflective in other markets as well. All right, so let's fast forward to October. Lots of write-downs. Lots and lots of financial institutions are writing off these losses because they had them, in which they were saying, okay, my mortgage-backed security is worth this much, but now it's only worth this much. So, you write it down when this much here that you've lost is not reasonably expected to be recovered. So note that the bullet point reads, the major international banks cleaned their books. I mean, clean books. This is what we want as investors. Don't we want transparency? Of course we want all that stuff. Now, central banks all over the world were trying this. The Fed's liquidity injections were fairly effective. In fact, some people cite the Fed as kind of, saving the U.S. economy at the time. So the Libor peaked in December of 2007. The TED spread was wide even further. But there were still liquidity issues. There were still credit issues. And so and the United States did something really fantastic here. They created this term auction facility, which was a short-term remedy. I mean, this was short-term. It was created in December. I think the date is December 12th. And what it did was give immediate access of commercial banks to a wide range of capital so that liquidity could be increased back to reasonable levels. What about these companies that insure the bankers? Okay, so in February of 2008, there was a big worry that the investment community was going to be brought down because of the downgrading of these monoline insurers. Oh my gosh, so what did these insurance companies do? Insurance companies like, you probably heard of Assured Guarantee or MBIA. What do? They insure municipal bonds, but they could insure, almost anything. So these losses were piling up. And the major rating agencies had no choice but to downgrade these big names. And so when one of them downgraded one of these insurance companies, there was quite a shock in the financial markets. So much so that the Fed lowered its Fed funds rate by another 0.5%. Bear Stearns was a big loser. They had large amounts of Fannie Mae and Ginnie Mae bonds on its own books. Call that agency paper. Look at this. They had 150 million trades spread across various counterparties. This is interesting. There was a general perception among the financial markets that the investment bank was kind of too interconnected to fail. 2ITF. I don't think we've heard of that one lately. So here's the deal. You got Bear Stearns, who has all of these trades, whether they were just simple contracts like a forward contract or maybe complex contracts like swap contracts or option contracts or credit default swaps, whatever they were, 150 million spread throughout the investment and larger economic community. Boy, if that failed, if that financial institution failed, it was going to have ramifications throughout all of its, can I use the term supply chain, at least on one side anyway. So they had some federal help. JP Morgan came in and bought it at $2 a share. Think about this, $2 a share for something that was trading at, my gosh, $150 a share a year before. Now, inside of all of this was an agreement to lend some capital to JP Morgan Chase. And that's another story in and of itself to be discussed at a later time. How about Fannie Mae and Freddie Mac? These are government chartered enterprises. They were the big losers as well. I don't think it was $2 trillion. The bullet point says $1.5 trillion in bonds. Now, of course, when you have this gigantic financial crisis, individuals, consumers, and financial institutions look for help. So where are they going to help? They're going to look to central banks. All right. So European Central Bank, inside of the United States, there was a tremendous injection of liquidity to try to help these margin calls and fire sales. The Fed reduced the discount rate down to 5.75. Later on, it was lowered another 75 basis points or maybe 100 basis points. And so the central banks were critical in trying to stop these liquidity issues from sustaining and causing long-term harm to the economy. I mean, clearly there was going to be some short-term ramifications. And we saw this in all different kinds of markets. I'm guessing that you guys are old enough to remember the events of 10 years ago. And so there were lots and lots of problems in fixed income markets and equity markets and derivative markets. But the Fed and other central banks were hoping that this could be confined to the relatively short term. And then, of course, we got past that and we did a bunch of stuff over the last 10 years. We'll talk about that in the future. So there's the recap of our learning objectives. Next up, we'll talk about the financial crisis itself.